Hello, everybody, and welcome back to another episode of the Rogue Agent Answers. My name is the Rogue Agent. Some people call me David Lewis, and every week I answer one of the many life insurance related questions that I've received from clients, from email subscribers on the daily email list. Questions floated to me from across the interwebs in the comments sections, which I know you're not supposed to read, or just interactions that I've had with people in real life over the past 20 years, which is a long time. And some of these questions I just scribbled down on scrap pieces of paper. Some of these are stuff I've written down on my phone. Some of it is on Post-it notes scattered all over the office. And every week I answer one of those questions. So if you'd like to ask your question, drop them in the comments section or join my email list for more life insurance tips and advice at monogenics.com. monegenics.com. Also, keep in mind that nothing in this podcast is or should be construed as financial, investment, legal, or tax advice. In fact, nothing that I say in this podcast should be construed even as insurance advice, as I don't give individual advice blanket just across the internet, unqualified, to random strangers. So if you need any of that stuff, contact a licensed professional that you know, like, and trust, preferably someone licensed in your jurisdiction. And now for this week's question. This episode marks the 1-year anniversary of answering these questions. Hard to believe I've been doing this for 12 months, an entire year, but here we are. Anyway, let's get into it and keep going, pushing forward. Let's see what we got here. What do I do? Okay, so how do I convert my whole life policy to an annuity? All right, this sounds kind of like a follow-up to last week's question. The answer is that basically you get a quote from the life insurance company about annuitization. And then you sign some paperwork, and then if you're happy with the annuity quote, then you convert it and you take your income and live happily ever after. Converting your life insurance policy to an income annuity is pretty simple. Income annuities are special income-based insurance products. They typically pay a guaranteed monthly income to you for life. And you can also set them up to pay an income to your beneficiaries when you die. So what else? Some income annuities, I guess they could be set up. Well, they could be. Some annuities will have like a cost of living adjustment, so that your income keeps pace. It's an inflation adjuster, so they'll keep pace with the general rise in prices for goods and services in the economy. So those can be good. Typically, what you find is that your income will start a little bit lower on those, and then each year the income will increase by a certain percentage. And the rider always has an extra cost to it. But over the long term, like especially if you live a long life, those riders can be really, really valuable. So converting your life insurance policy to a deferred annuity, which you could do that too, is going to defer the income until you want or need it. So if you just don't want your life insurance policy anymore, or you know you're going to have income, you can convert it to like a deferred annuity, either an indexed annuity or a fixed annuity of some other kind, or you could convert it to a variable annuity. During the deferral period, you generally have access to 10% of the account balance without a partial surrender or without a withdrawal penalty. So you can still get at the money if you need it. The IRS also considers any withdrawals as gains before the return of principal. So it switches. It's not going to be like what you had with your life insurance policy. It's not going to be tax-free up to basis. So you're going to pay income taxes, on any gains that you make. And those are going to be taxed at ordinary income rates whenever you make a withdrawal from the annuity. Let's see. Conversion from life insurance to an annuity is it's a 1035 exchange, so it's going to be a tax-free transfer. It's considered like transfer. But you cannot transfer money back into your policy tax-free. So if you can only go one way. You can only go from from life insurance to an annuity. You cannot go from an annuity into life insurance. So for whatever reason, I'm not sure exactly why those rules are set up that way, but that's the way they're set up. So you have to be pretty sure that you're not going to want to come back to a life insurance policy later with that money. It's a one-way street. So you can go to the annuity and that's it. So this is really for people who are absolutely certain that they're going to trade their life insurance policy in for an income, a guaranteed income at some point and down the road. But like I said, it's a fairly easy, simple transfer. It's routine kind of thing that happens all the time. People eventually want to get something out of their policy, and going the annuity route, usually you can get more money out of it that way than if you try to do policy loans or straight up withdrawals, because the annuity guarantees a really high payout. And because what they're doing is they're giving you back some of your principal, and they're giving you back some interest gain and principal. But unlike with the life insurance policy, they're going to guarantee those payments, right? So life insurance doesn't guarantee the payout. It guarantees the accumulation, but it doesn't guarantee the payout. And so the annuity reverses that and guarantees the payout. Okay, so what it's doing is saying you could convert, let's say $1 million and convert it to, I don't know, just say it was a $70,000 annual income. They'll pay you $70,000 regardless. So even if you were to blow through the entire, you take $70,000 a year, and even if you live long enough to blow through the entire $1 million, they'll still keep paying you the 70 grand until you die. And if it's adjusted for inflation, it's like 70,000, then 72, or whatever. They'll adjust it upwards. They'll just keep doing it until you die. And then they'll give beneficiary payments. Usually it's like a 10-year period certain. So your beneficiaries might get like 10 years worth of payments even after you die. So it's not a bad deal. It's not a bad deal for the right person. You want income. It's a very attractive payment option. It's not necessarily for everybody. Again, if you want to keep your life insurance and it's something that you want to pass on to your heirs, and you can, or your life insurance policy is so big, you've accumulated so much cash surrender value that you just don't need to convert it, and you can safely withdraw dividends and live off the dividend income. That's fine. That's great. You do that. And if it's something you want to pass the life insurance policy on to your heirs, the death benefit, you'd be much better off just keeping the life insurance policy. So it just depends on what you want to do with it, and how much money you've got built up in your policy. And at the end of the day, this is really not so much about, there's a lot of marketing gimmicks and stuff about tax-free income from life insurance policies. At the end of the day, it's about, are you going to pay more in policy loan interest or income tax? And even if you had to pay taxes, it's just it's numbers on a sheet, right? You just label it taxes or interest. You're going to pay one of those two, to get your money back out. So either one, you're just kind of making the decision about what it is that you're going to do. If you're not paying back your policy loans, and you're not focusing on growing your capital base, like with life insurance, you don't mind paying interest because that money is ultimately flowing back to you and building up your capital base. But if you're not going to be repaying those loans, the loan interest is going to start compounding against you, and eventually it's going to start costing you money. If you are repaying your loans, your system is growing, right? Your policy is growing. Your capital base is growing. If you're not repaying those loans and just drawing off income, then your capital base eventually is going to start shrinking. So again, you just have to decide, and it's just looking at the numbers. What am I going to pay? Which way is going to cost me more money, and then choose the one that's going to cost you less money. Anyway, that's my answer on that, and I hope that helps. And thank you for asking a question, and keep them rolling in, and I will keep answering them. And maybe I'll keep doing this for another year. Who knows? But I would definitely be doing this for at least another week. So I'll see you in the next one.
Okay, that's it for this week's question. If you'd like to add your question to the list, just drop them in the comment section or send me an email. And if you want more life insurance tips and advice, just head on over to monogenics.com, monegeniix.com, and sign up for my daily email list.